Hello, I'm John Lynch, Chief Investment Strategist for LPL Financial. Welcome to this special edition of Street View Video. At LPL Research, we're very excited to release our Outlook 2020, bringing markets into focus. Unlike last year, if you remember at this time when the markets were falling out of bed, this year the financial markets are very strong in the fourth quarter. Last year when the markets were tanking, we were concerned about the technicals, obviously, but in spite of that market weakness, we had a lot of conviction relative to the market fundamentals as well as the valuations that were presented to us in the fourth quarter of 2018. So as the year progressed, obviously the markets rallied quite a bit. As we're releasing the 2020 outlook, curiously, unlike last year, we have very strong market technicals, but given the way financial assets have risen, we don't have the conviction that we had last year on the fundamentals and valuation. We still think fundamentals look good, they're just not as great as a year ago at this time. And from a valuation standpoint, we are concerned whether looking at a forward or trailing basis, valuations appear stretched currently. To summarize our forecast for 2020, we're looking for slightly less economic growth in the US, slightly higher inflation, consequently slightly higher interest rates. After flat profit growth for 2019, we think profits are going to grow at an historically average rate, call it 5 or 6%. And then looking at global growth, we think global growth will be about even from where we were last year. And then looking at the financial markets, if market interest rates rise slightly as we project, we believe the S&P 500 will rise commensurate with profit growth. This past year, we saw an awful lot of price to earnings ratio multiple expansion, whereas this year, going into 2020, we think its market drivers will be purely based on earnings. So if you see here on the chart, relative to where we were in 2018, where we saw about 3% economic growth, this past year, the trade uncertainty, unfortunately, really weighed on the other drivers of fiscal policy that we've talked so much about, whether it be regulation, government spending, tax cuts, for example. But with the uncertainty of trade, we clearly have had some good news over these last couple of weeks at the end of 2019. We're actually taping this on December 17th in the morning. And what we've seen thus far is some clarity on phase one with trade with China. We've seen NAFTA 2.0 progressing. We've seen an elimination or delay of the European auto tariffs. And we've seen a Federal Reserve that appears to be on hold for 2020, as well as the European Central Bank and the Bank of Japan, which appear committed to further reduction in interest rates, or at least policy accommodation in 2020. So if we look at economic growth, trade probably weighed on economic growth by about a full percentage point, which is why we saw that decline from 3 to call it 2%. We're looking at slightly less, calling it 1.75% GDP in the US in 2020, largely because even though we just got phase one, we think it's going to take a while to implement some of those business investment plans. Also, the election is going to weigh, I believe, on sentiment. Our analysts, and we've discussed this quite a bit in the LPL Research Department, and to the degree one party tells us how great things are and another party tells us how awful things are, we do suspect that that could weigh on sentiment. And it's conceivable that businesses and consumers kind of tap out in the fourth quarter. So we might see less growth in the first quarter and less growth in the fourth quarter during 2020, with the bulk of the gains from an economic output standpoint in the two mid-quarters for 2020. Inflation, we think the Fed and the European Central Bank and the Bank of Japan are going to let prices run a little higher, a little hotter than they have in the past, because we want to make sure they really see pricing pressures entrenched in the economy. Remember, 2% inflation is a target for price stability. It's not runaway pricing pressures, and I think that's something investors need to keep in mind. Looking at global economic growth, we still struggle with what's happening in Europe, whether it's Brexit, Italian debt situation, nationalist parties gaining more strength. We do believe that you're going to have a struggle to see 1% growth in Europe as well as in Japan. Japan had the value-added tax put into place in the fourth quarter of 2019. We saw really strong growth in the third quarter as consumers pulled forward growth, if you will, and we think that'll be a dynamic, particularly once fourth quarter GDP in Japan is released, as well as first quarter GDP 2020 for Japan. So in the developed world, only looking at about 1.5% growth. Still very impressed with the emerging markets. We think they've done a great job not only balancing the changes from slower growth out of China, but they've done a really good job in our estimation of embracing the globalization of services. So we're still looking at about 4.5% economic growth, similar to where we were in 2018. Call it 4.5, 4.6% in 2020 for the emerging space. Globally, you factor all that together, we're looking about a 3.5% pace of growth for the global economy, which is a good pace of growth, particularly when you think about where we are domestically, year 10 or 11 of this cycle, still a pretty good print there. Relative to interest rates, we do believe the Fed's on hold. Whether you look at trillion-dollar budget deficit or what we expect to be a Fed willing to let inflation run, we think market interest rates are going to nudge a little higher, and we're looking for the 10-year Treasury to spend the bulk of the year in that 2 to 2.25% range. Operating earnings for the S&P 500, we had 20% earnings growth in 2018, essentially flat, maybe 1% type growth, 2% type gains in 2019. We think we're going to return to an historically average pace, call it 5 or 6% earnings growth in 2020, and using a multiple PE ratio of 18.5, 18.75 in a still low historically average, and relative to historical averages, a low inflation environment. We think an 18.5 trailing PE on that 175 and operating earnings can get us to that 3,250 to 3,300 range. Now, I recognize that's very close to where we are now, but we do believe that given this huge surge that we've seen in asset prices this year, we'll likely have experienced more volatility during 2020, and consequently, we're still going to be looking at that 175 in earnings. And to the degree phase 2 of trade picks up and we see an enhanced business investment environment, we do believe we would have upside risk and actually raise that earnings estimate, but we want to see improvement on phase 2 first. More specifically on the U.S. economy, I think it's important for investors to embrace and appreciate where we are in the cycle, and to the degree that growth slows. A message we've been delivering for the past year has been slowing but still growing, and I think that's best illustrated in this chart, where you clearly see the downward trajectory. But in year 10 or 11 of an economic cycle, I want you to think of sprinting, and the market kind of has to catch its breath. The economy needs to catch its breath after such a long cycle, if you will. But looking at that transition, the key remains trade. As we get clarity on trade, we're still looking at a very strong consumer, fully employed consumer, yet businesses need to keep investing to elongate the cycle, to increase productivity, so the cycle can continue without slipping into recession or mid-cycle slowdown. We did experience mid-cycle slowdown in the manufacturing sector over the last couple of quarters, but we're starting to see, in fact, just this morning, December 17th, we saw a really good industrial production number for November. So we think as clarity on trade improves, we start to see business investment increase also. So we do think that the economy, although moderating, still good growth, call it just below 2%, that 1.75% print. Again, strong consumer, some government spending, private investment or business investment really will be key. And as we get trade, we see an export benefit as well. Looking at the next chart relative to inflation, while consumer inflation has been nudging higher, again, we must emphasize 2% is a target for price stability. It is not runaway inflation. And when we look at wholesale prices, the prices businesses pay, we're seeing wholesale prices decline, which is the black line, and we're seeing consumer prices start to increase slightly. So still well below historical averages, but we're looking at that decline, as you see here during the pattern exhibited on this chart. The decline in wholesale prices can be a leading indicator for a weight, if you will, on consumer prices. And if you look at the final chart here on inflation for the U.S. economy, the real key is wage growth. 70% of business costs are wages, and if wages aren't rising at a threatening level, we believe that's indicative of a good pricing environment. When you typically see wage growth in that 3% range, we're kind of in the sweet spot, if you will. Historically, 4 or 4.5% wage growth is where the Fed feels the need to slam on the brakes to slow down economic growth. We're in that 3% range, even with a sub 4% unemployment rate. We believe employment will grow in that 150,000 jobs, 175,000 jobs per month in 2020. Clearly not the pace of 225 or 250 that we grew accustomed to in 2018 and the first half of 2019, but nonetheless, still a pretty good number. And then when you look at the global economy again, 4.5% or so from the emerging space, 1.5% or so from the developed space, looking at overall global economic growth of approximately 3.5%. We believe that policy is going to continue to play an exceedingly important role in financial market and economic performance in 2020. Because if you think about it, government plays an important role in determining policy. And the way government, if you will, has levers that they can pull to get the economy going, it can be government spending, taxes, regulation, and trade. I think we'd all agree that regulation, taxes, government spending have been tailwinds, but the headwind of trade has kind of overwhelmed, or trade uncertainty has overwhelmed the benefits of the other three tailwinds. So consequently, getting clarity, as I mentioned earlier, on NAFTA 2.0, a delay of the European auto tariffs, phase one agreement on the U.S.-China trade opportunity there, and to the degree that phase two is currently being worked on already, to the degree we get that progress, we think that will be very important, not only to improve economic growth, which improves business investment, which enhances productivity, and ultimately can help sustain margins. So not only do you see an economic growth benefit, but also a financial market benefit as well. So you look at government, you look at trade, and in that environment, we still are looking at central banks being the primary driver. Remember, really from 2009 through 2016, 2017, it was the central banks. With the 2017 Tax Cuts and Jobs Act, we started to see fiscal policy be the primary driver. But once the Federal Reserve raised rates 4 times in 17, then cut rates 3 times in 18, central banks are back in charge. And if you see here on the chart, our Federal Reserve, our federal funds rate is significantly higher than interest rates globally, but particularly if you look at the other major central banks, Bank of Japan, which has negative rates, as well as the European Central Bank. So there is still a bid for us in spite of our spending profligacy, and I believe that's something to keep in mind. There's an interest rate differential that our Federal Reserve must keep in mind. There are many factors to consider. The Fed has to look at jobs and inflation as their primary mandates, but the Fed also has to look at the currency, whether or not they want to admit it. The dollar can't get too strong in an environment when interest rates are negative. Emerging markets hold about $4 trillion in dollar-denominated debt. Our interest rates can't get too high. Their currencies can't get so weak that they have an inability to service interest payments on that debt. And then you have to look at food costs also in the emerging space. 6 billion people live in the emerging markets, and if you factor in food prices, may account for approximately 10% of food costs in the West. They're about 1/3 of food costs in the East, which is yet another reason why our currency can't get too strong relative to others. So we do believe the Federal Reserve will be on the sidelines in 2020, obviously monitoring jobs, inflation, but also the currency as well relative to other interest rates around the world. Now, those economic and policy decisions and implications will certainly affect the bond market. And in 2019, the story for the bond market was the yield curve. You're all familiar with the fact that the yield curve flattened and on several occasions inverted during 2019. Now, we have a long-term chart here on the yield curve to show just how infrequent inversions are. Now, an inversion of the yield curve is when short rates are higher than long-term rates. Now, a message that we were consistent in delivering over the past year was that there were unique circumstances this time around which drove the yield curve to flatten, if not invert. Again, short-term rates as measured, say, by the 2-year Treasury relative to the 10-year Treasury yield. And historically, when we have seen inversions, the dark shaded areas are recessions. Historically, what we've seen is that when the yield curve inverts, inflation is running higher, the market is anticipating tighter Fed policy, so short-term interest rates rise faster than long-term interest rates, causing the yield curve to invert. Now in 2019, what happened was that there was no inflation, yet the market saw concerns about monetary policy, absence of inflation. So what we experienced, and also there was a valuation story, and what we experienced was that long-term rates were falling faster than short-term rates, which caused the yield curve to invert. So we didn't believe it was sending a recession signal like it had been sending previously, because if you see on the next chart, with negative interest rates globally, at the peak in September, we saw $17 trillion in negative interest rates globally. I used the term earlier, there was a bid for us in spite of us. In spite of our spending profligacy, global investors see 175, 180 on the 10-year Treasury, for example, relative to, at the low point, we had a German Bund, which was negative 75 basis points, and the Japanese government bond was also yielding a negative offering for investors. So there was a bid for us in spite of us, because global investors thought the 10-year Treasury was a very attractive value on a relative valuation investment for them, even with hedging costs. So in this environment, to position fixed income portfolios, you will see some, but not an overweight, treasuries within the fixed income portfolios, because we still believe that treasuries offer income, liquidity, and they can help smooth out market volatility during periods of equity market duress. But we're going to emphasize investment grade corporates. Remember in 2017, when the Fed was raising rates, our overweight was on high yield bonds, tend to do better in a rising rate environment. This past year and in 2020, we'll continue, now that the Fed's on hold, we'll continue to look at investment grade corporate bonds as an overweight. And then for a risk reward, slightly higher market interest rate environment, you're going to see an overweight in mortgage-backed securities as well. Now, when we look at the equity markets, at LPL Research, we continue to focus on three areas: technicals, fundamentals, and valuation. As I mentioned earlier, a year ago at this time, technicals were terrible, and we had strong conviction in fundamentals and valuation. Currently, technicals are great, and our conviction is good, but just not as great as it was last year relative to fundamentals and valuation. If you want to think about the S&P 500 in late December, trading in that 3175 to 3200 range, looking at some technical support levels, 50-day moving average is about 3,050, and 2,950 or so is the average trading price over the last 200 days, which we believe could offer some support levels. And it's conceivable we may test at least the first one in early January as investors just reassess growth, because from a fundamental standpoint, we've got good GDP, right? Slightly less than where we were last year, but still around 2%. We have good inflation numbers. We have very strong consumer, strong employment, improving manufacturing, very solid services numbers, good global growth in that 3.5% range. So there are some fundamental supports. Yet, from a valuation standpoint, on the PE basis, we're trading about 19.5 times trailing earnings and 17 or 17.5 times forward earnings. Now that's expensive relative to history, because historically, if we're at 19 times trail now, we're typically 17.5 or 18 times trail. And on a forward basis, we're usually 15 or 16.5 times forward earnings. So perhaps some of that may have to come down, so it's conceivable we see some volatility in January just as investors reassess. If we do see that, I would view that as an opportunity, because relative to profits, that's really what we believe will be the market driver. If the market PE ratio expanding was such a big driver in 2019, we think the story in 2020 will be profitability. So as you see, 2019, we saw very good earnings of approximately 20% growth in 2018, essentially flat to up 1% in 2019. Now we're looking for approximately 5-6% historically average earnings growth in 2020. Now, earnings should always be viewed on a relative basis. So if you look at the next chart, relative to domestic profit growth, operating earnings for the S&P 500, relative to that of the emerging and the developed space, we see good earnings growth. The consensus forecast is looking at about 10% for developed international, which would be the lightest of the blue. Since I live in North Carolina, I'll call that Tar Heel blue. And that number is looking at about 10% earnings growth in the developed space. That may be a little aggressive. I'm not convinced with 1% economic growth you can see profitability that way, but the year-over-year comparison is relatively easy. So I think it'll be close, but not that high. Same thing with the emerging space, which is the darker of the shaded bars on the 2020 column. And what we're seeing there is about 14 or 15% earnings growth. It's a good number. It might be closer to 12, but nonetheless, a pretty good number, and I think that's a number you can base market growth on. Again, we don't want to look for profit growth, rather PE growth, price to earnings ratio growth, driving stocks in 2020. And looking at the U.S., the consensus estimate as of early December when we released this report, we came out with operating earnings of $175, an operating earnings estimate, which is about a 5 or 6% print from last year's or 2019's $165 number. So looking at that, good earnings growth, not as good certainly as 2018, but that's okay. We're in year 10 or 11 of this economic and profit cycle, so we do think it's a healthy number. How we will be positioning portfolios in a market that will be determined by profit growth. When we make investment decisions, we're going to overweight large relative to small caps. We are going to overweight emerging relative to developed. We are going to equally weight or balance the growth and value dynamic in investors' portfolios. And finally, from a sector standpoint, we are going to look at the more cyclical areas of the market, industrials, for example, relative to the defensives, if you will, utilities or REITs, for example. Now, when I consider sources of volatility that we should anticipate in 2020, we obviously have a consistent geopolitical threat, right? So we always have to be mindful of that. Clearly, we've talked enough about trade. So those are two areas that can weigh on investor sentiment. But we can't ignore certainly the impeachment process, nor can we ignore the 2020 election. Now, looking at impeachment, only have 3 or 4 examples, right, throughout history. 1868, we really don't have too much data to see how the markets did. When you look at President Nixon's scenario, the economy was already in recession, the market was already struggling in a bear market. When you look at the President Clinton situation, we were in a bull market. And in the current situation, we are also under the Trump administration, we are in a bull market. So consequently, the data is not statistically significant, but what I think we could all agree on is that at differing times during the course of the coming year, we believe that investor sentiment will be affected by threats of impeachment, negative headlines, fear of the unknown, and relative to the election as well. So during those periods, when we expect volatility to increase, at LPL Research, we're going to continue to focus on 5 key fundamentals, if you will. We will always be looking at what's happening with GDP, inflation, profits, interest rates, and employment. So if you look at GDP, inflation, employment, interest rates, and profits, during all the uncertainty of the headlines relative to impeachment or the election, we'll be emphasizing those 5 key areas when we're making investment decisions. Now, looking at the election, when you see a variety of issues surfacing, I think it's important to recognize this chart. The Mr. Market tends to figure it out. And when looking at the election, a couple of things to keep in mind. The 4th year of the presidential election cycle typically sees about a 6% return. We're looking at 6% profit growth in 2020, and we think profits will drive market growth higher. We also were up north of 20%, and we've seen that in years when the market has been up by more than 20%, the ensuing year or the following year is up by an average of about 6%. So if you want to think about 6% relative to profits, relative to the 4th year presidential election cycle, or years after a 20% plus gain in the market, I think that's something where you can look to history for market guidance, but also market performance in the 3 months leading up to the election. In 20 of the 23 last experiences, going back to 1928, if the market was up in the 3 months up to the day before Election Day, the incumbent party won. Only on 3 instances did we see that conflict with historical averages. And I'll spare you all the details, but more often than not, 2016 was a great example. Market was down, and I think the consensus said that Hillary Clinton was going to win, yet nonetheless President Trump won, even the market was telling us the same story. So we have to pay attention to what the market's doing. As we get past Super Tuesday, in our mid-year outlook, Super Tuesday will be in early March. We will write a variety of weekly market commentaries, and our mid-year market outlook will have more in-depth analysis relative to the election. Right now, with approximately 15 candidates on the Democratic side running, the impeachment process going on the other side of the aisle, we just need to be very mindful of that. So before we get historical data and looking at immigration, taxes, regulation, government spending, trade, some healthcare, drug pricing, for example, we want to wait and let's get through Super Tuesday, and I think you're going to see more clarity for each party platform. So to conclude, in our Outlook 2020, bringing markets into focus, we want to provide you with the insight, the vision to look into 2020 to help you make sound investment decisions. We don't believe it's going to be a straight line. We do think that volatility is going to increase next year again relative to geopolitics, impeachment, and the election. All those uncertainties can weigh on investors' mindset, but nonetheless, we'll continue to be focusing on policy and its implications for economic growth, what that means for interest rates and how that'll translate into bond market performance, and ultimately what happens with corporate profits. Again, if we get any clarity on phase two, I suspect we'll see higher earnings forecasts coming from LPL research and consequently a higher fair value estimate for the S&P 500. So looking at policy, economy, impact of rates on the bond market, impact of profits on the equity market, weighing down uncertainties relative to impeachment, the election, geopolitics, again, focusing on those fundamentals, we believe that will provide our investors and all investors with the clarity they need to make sound investment decisions in 2020. We appreciate you watching this extended version of our Street View video series. And if you would like further information, please go to lpl.com for other collateral relative to our 2020 outlook. Thank you. Have a happy and healthy 2020.